$9,000. That's the raise you got this year, after taxes were supposedly already accounted for. And somehow, your bank account still looks almost exactly the same as it did back in January. Not smaller by much, not bigger either, just the same. Like the raise never actually happened. You worked for it. You earned it. Review after review, quarter after quarter. On paper, you make more money than you ever have in your life. But the number in your checking account on the 28th of the month tells a completely different story than the number on your offer letter. Here's what nobody explained to you at that performance review, in that meeting where your manager smiled, shook your hand, and said the number out loud like it was the end of the conversation instead of the beginning of one. A raise is not one event, it's a trigger. It sets off 5 separate reactions across your finances all at once, and almost none of them show up anywhere on your pay stub. The first reaction is the quiet one. Your tax withholding shifts. Not because the government suddenly wants more from you, specifically because you crossed into a slightly higher slice of income, and only the portion above that line gets taxed at the higher rate. Most people don't actually know that. They hear higher tax bracket and assume the entire raise gets taxed at the new number. It doesn't work that way. But payroll software often rounds up anyway, withholding a little extra from every single check, just to stay on the safe side. That extra comes out before you ever see it. Every 2 weeks, 52 weeks a year. The second reaction happens inside your 401k, and it's almost invisible. If your contribution is set as a percentage, say 6% of your salary, a bigger salary automatically means a bigger dollar amount gets pulled out of every check. 6% of an extra $9,000 is over $500 a year, gone from your paycheck before it ever lands in your checking account. That's genuinely good for your future self. It does absolutely nothing for the version of you standing at the grocery store checkout this week. The third reaction is the one almost nobody sees coming, and it's the most expensive one for a lot of families. If you're on a marketplace health plan, or your household income sits near certain federal thresholds, that raise can quietly shrink your premium subsidy. Some families lose $40, $60, even $90 a month in assistance the moment their income crosses a specific line, a line most people have never heard of until it costs them money. Nobody sends a letter that says, "Congratulations on the raise. Your health insurance just got more expensive." It just shows up, quietly, on the next bill. The fourth reaction lives inside student loans. If you're on an income-driven repayment plan, your loan servicer recalculates your monthly payment once a year, based on your most recent income. A $9,000 raise can push that number up by $50, $80, sometimes well over $100 a month. That new figure shows up on a statement you skim for 10 seconds and barely register. And the fifth reaction isn't the government's doing it all. It's yours. And it's the sneakiest one of all 5. Psychologists call it lifestyle creep. You feel richer, so without ever consciously deciding to start spending like it. A slightly nicer car with a slightly higher payment. More takeout on a random Tuesday because you deserve it now. A streaming subscription you upgraded and forgot about. None of these individually feel like a decision. That's exactly the problem. Nothing announces itself. It just quietly adds up. Now, take 2 people. Same $9,000 raise. Same calendar year. 2 completely different outcomes. 6 months later. Daniel, 38, works in logistics, just outside Columbus, Ohio. When his raise hit in March, he didn't check a single thing. His 401k contribution auto-increased right along with his new salary. Technically a good thing, but he had no idea it happened. His student loan servicer recalculated his payment 3 months later, quietly adding $91 to his monthly bill. His marketplace health plan subsidy dropped by $55 a month because his new income crossed a threshold he genuinely never knew existed until his broker mentioned it. And somewhere between a new phone plan he barely uses and eating out twice a week instead of once, another $200 a month simply evaporated into nothing memorable. Add all 5 leaks together. $346 a month disappeared. Over a full year, that's $4,152 of his $9,000 raise gone, before Daniel ever felt genuinely richer. Elizabeth, 52, works as a regional sales manager in Tampa, Florida. Same size raise, same calendar year. But she did one thing differently, and it took her exactly 20 minutes. The week the raise was approved, she sat down with her latest pay stub and a simple withholding calculator. She checked her new numbers and adjusted them, so she wasn't quietly overpaying the IRS every single check for no real reason. Just to get a refund next spring, she didn't need. She left her 401k percentage exactly where it was for 90 days, banking the extra contribution on purpose instead of letting it happen by accident and forgetting about it. She called her loan servicer directly, confirmed her new recalculated payment 3 months before it took effect, and built it into her budget before it could surprise her on a random statement. And she made one simple rule for herself. Before the raise ever touched her checking account, half of every raise goes toward a goal with a name attached to it, in her case, her Roth IRA, and only the other half touches her regular day-to-day spending. Here's the difference, laid out in plain numbers. Daniel's $9,000 raise turned into roughly $4,800 of real, felt improvement in his actual life. Once you account for all 5 leaks working against him quietly, all year. Elizabeth's $9,000 raise turned into closer to $7,800 of real improvement, $4,500 going directly into her Roth IRA on purpose, and the rest genuinely changing her month-to-month life on things she actually chose. Same raise, same year, same starting income. A $3,000 difference in year 1 alone, created almost entirely by 20 minutes of attention. Now stretch that single decision forward across time, because this is where it actually matters. Elizabeth's extra Roth contribution, growing at the stock market's long-run historical average of around 10.5% a year, turns that 1 year's decision into just under $19,000 by the time she reaches 65. One raise, one 20-minute conversation with herself. $19,000, decades later. Daniel's 4,000 leaked dollars? They're simply gone, not invested anywhere, not compounding for him in any account. Just spent quietly on a version of a year he genuinely can't specifically remember or point to. There's a third story worth knowing, because it shows how much worse this can get when 2 incomes are involved. Robert and Susan, a married couple, in their 40s outside Denver, Colorado, both got raises the same year. His was $6,000. Hers was $3,000. Individually, neither raise looked dangerous. Combined, their household income crossed a marketplace subsidy cliff neither of them had ever heard of, the kind where losing eligibility isn't gradual, it's sudden. Their monthly premium assistance didn't shrink a little. It dropped by close to $300 a month, nearly overnight, the moment their combined income crossed that specific line. Nobody at either job mentioned it. Nobody warned them it existed. They found out the way most people do, a bill that was suddenly, unexplainably, much higher than the month before. Over a year, that's roughly $3,600 of their combined $9,000 raise gone to a single number neither of them had ever calculated in advance. The lesson isn't that raises are dangerous. It's that nobody checks the combined number until the bill already reflects it. This is also worth saying plainly, because it changes how you should think about timing. A raise that lands in January behaves differently than one that lands in September. Get a raise early in the year, and the higher withholding, the bigger 401k percentage, and any subsidy change all compound across 11 or 12 full months. Get that same raise in September, and you might only feel 3 or 4 months of the effect before the calendar resets, which can make a September raise feel deceptively harmless, right up until January, when a full 12 months of the new number hits all at once, unannounced. This isn't a story about being cheap, and it was never about restriction. Elizabeth still went out to dinner that year. She still eventually upgraded her phone when the old one finally died. The real difference wasn't that she spent less. It was that she decided, in advance, where the raise was going to go, instead of quietly letting 5 invisible systems decide it for her, one small leak at a time. So here's what actually works, laid out in order, starting the week your next raise arrives. Step 1. The week you get a raise, before anything else in your finances changes, check your new withholding using a simple paycheck calculator. Most banks and the IRS both offer free ones online. Most people are genuinely shocked to discover they can adjust their withholding and keep more money in every single check, instead of waiting 5, 6, 7 months for a refund they didn't actually need to give the government in the first place. Step 2. If your 401k contribution is set as a percentage of your salary, let the extra automatic contribution happen for the first 90 days completely on purpose, not by accident. It's the exact same dollars either way. The only real difference is whether you consciously decided to save that money or simply never noticed it left your account at all. Step 3. If you're on a marketplace health plan or you have income-driven student loans, call and ask one direct question. Does this raise change my subsidy or my monthly payment? And exactly when does that change take effect? 20 minutes on the phone beats an unexplained, unpleasant surprise on a bill 3 months from now. Step 4. Before the raise even lands in your account for the first time, decide on an actual number, written down somewhere you'll see it again. Not a vague feeling, a real number. Half goes toward something with a specific name attached to it. Half goes toward genuinely enjoying the extra money you worked all year to earn. Not zero enjoyment, ever. Just an intentional split, decided calmly in advance, instead of an accidental one discovered later. Step 5. Set a calendar reminder for exactly 90 days out from your raise. When it goes off, actually look at your accounts. Ask yourself one honest question, out loud if you have to. Did this raise genuinely change anything about my life? Or did it just quietly disappear the same way every single one before it always has? A few honest questions people always ask at this point. What if the 90 days pass and you never got around to checking? Nothing dramatic happens, you just quietly become Daniel instead of Elizabeth for another year without ever deciding to. What if your raise was smaller, say $2,000 or $3,000, not $9,000? The same 5 leaks still apply, just at a smaller scale. The withholding still shifts a little, the 401k percentage still pulls a little more, and lifestyle creep doesn't actually care how big the raise was, only that it happened. What if you already spent the raise before reading this? That's fine. The next one hasn't happened yet. The system doesn't punish you for missing this time. It only keeps working exactly the same way, quietly, until someone decides to look. And one more thing worth saying clearly. None of these 5 leaks are secret, and none of them are unfair. Withholding tables are public. 401k percentages are visible in every account dashboard. Subsidy thresholds are published by the government. Loan servicers send statements. Your own spending shows up itemized in your banking app right now, today, if you open it. None of this is hidden from you. It's just never been pointed out. All 5 pieces, side by side, in the order they actually hit. Because here's the truth, almost nobody says out loud, on camera or off. It's not that raises don't work, and it's not that the system is rigged against you specifically. It's that most of us have never once actually watched, closely, where our raise really went. We just assumed more income automatically meant more money sitting there at the end of the month. Nobody ever sat us down and pointed to the 5 specific places it quietly leaks out first. One small percentage at a time, before we ever get a real chance to decide. Picture your account. Honestly. 5 years from exactly today. Not the version you hope for. The version that actually happens if nothing changes. One version looks almost identical to how it looks right now. A little more income showing up on paper each year, sure. But somehow, always, that same familiar tight feeling by the last week of the month, no matter how many raises came and went in between. The other version has a real, specific number sitting somewhere with your name on it, growing quietly in the background whether you think about it or not, because one raise, just one, finally got treated differently than every single one that came before it. You already earned the $9,000. Nobody can take that fact away from you now, no matter what happens to the rest of it. The only real question left, the one that actually decides which of those two versions of you shows up 5 years from today, is whether you're going to go find out exactly where it went this time or let it happen again next year, quietly, the exact same way it always has before. Daniel eventually did look, by the way, almost a year later, after a friend asked him a version of this exact question at a barbecue. He ran the numbers, saw the $4,152 laid out in plain sight, and didn't feel angry about it. He felt something closer to surprised, the way you feel when you finally see a bill you'd been avoiding opening. The next raise, 6 months later, he did it differently. Not perfectly, he forgot to call his loan servicer until month 5, but the withholding got checked in week 1, and the split got decided before the money ever landed. That's really the whole difference. Not a better income, not a smarter account, not luck. Just 20 minutes, spent once, on purpose, instead of never, by someone who finally decided to look before the money quietly disappeared again.